Welcome to Lighthouse Outlook, the podcast where we talk less about the markets and more about what matters to the people navigating them. From family offices to founders, we go beyond the numbers to unpack risk, legacy, and the human side of capital. Hosted by the team at MacNicol and Associates Asset Management.
Well, welcome everyone. This is our ongoing podcast series, and we're very pleased to have John Ing of Maison and Placement here, and John will introduce himself shortly. For those who don't know who I am, I'm Dave MacNicol, and I run a firm called MacNicol and Associates Asset Management. And you'll be hearing everything you need to know about gold and precious metals and a bit of an economics lesson, I bet. So here we go. One thing I want to do before we start this conversation is just show you what gold has done. So these are pretty fresh numbers to last night's close, and down here on the bottom, you can see gold and silver is just shot it out of the park here, knocked it out of the park, 245% over the last year. In the last month, 62%. And then out here at 10 years, the best performing asset class on a 10-year number, even beating the NASDAQ, which gold falls slightly behind. Gold has not done as well, but this is just tremendous what has happened here, and we've been well positioned in advance of this. We're not playing catch up like people are right now, but I just wanted to let everybody know what's happening in the gold space. So, John, I'm going to pass it over to you. Just tell us a little bit about yourself and who you are and your background.
Well, always happy to talk to you, David. We've known each other for some time, and not only because of the interest in gold, but it's basically the investment market is sort of, we're both students of the market. I've been involved my career, I guess, is probably 50 plus years in the investment business. And I've uh, born in Montreal, and I've been following gold ever since I first got into the investment business. Started as a trainee, actually started as a chalk boy at one time. It was very archaic, was writing quotes on a blackboard for a summer job. And then that was a portfolio manager trainee. And one of my first accounts was a synagogue which held a lot of gold. And I said, Rabbi Stern, you hold too much gold. And he says, how long you been in the investment business? And I said, well, a very short time. He says, I can tell. So he gave me these bunch of books to read. One of them was the interest rates, the history of interest rates by Sidney Homer. And I read all the books over the weekend, and he says, come and see me. And I went to see him after I read the books. And he says, what did you learn? I said, Rabbi Stern, you don't have enough gold. So I've been following gold ever since then. And it's I've seen bull markets and I've seen decades of a bear market. And everybody feels truly when they look at gold, they say, oh, you're a gold bug, or the gold doesn't pay any interest, or gold is too speculative. And one thing I learned from these books and now through history is gold is an insurance policy. It is um, a store of value historically, but it's an insurance policy. So one buys insurance, fire insurance on your house, and you don't hope your house to burn down to collect on your fire insurance. In fact, you buy insurance just to protect your house, your assets. And that's what gold is. It's a insurance policy. It's a hedge against uncertainty. And I have to admit, in the last 2 years, it certainly has been a very, very effective insurance policy. So throughout my career, I have been following gold. And then that, of course, takes me into where does gold come from? And that's the gold miners. And then early on in my career, interviewed a lot of the gold miners that were around that day. I can recall Paul Penna, who started Agnico Eagle. When Agnico Eagle was market cap was probably less than $6 million, and when Paul, I used to see Paul, and he was just happy to be Agnico at a $20 million market cap, and I was with him when he made the first big acquisition, Larone Mine, which was Dumogamy at the time, and he paid less than $3 million. Today, I think market cap of Agnico Eagle's $100 billion, $100 million. So it can tell you that that these gold miners, sort of the truism is from acorns you get trees, and I've been following the miners for some time, and it's been my thesis, particularly of late, is that we haven't found that many gold mines in the world. In fact, there's something only about 22 gold mines in the world that produces more than 1 million ounces a year. And so gold has become not only was a precious metal, but is become a critical metal. And I say that because there have always been buyers like myself and other gold funds, like and other private funds. MacNicol was a buyer is a buyer of bullion, for example, and some of the gold stocks. But there's always a buyer, but there's been fewer sellers of gold. And in the last couple of years, central banks have been big buyers of gold. The last 3 years, they bought 100 tons, 1,000 tons each year. Last year, when gold price moved up, they bought now about little under 900 tons. So what does that mean? Well, that represents something like 25% of the world's supply every year has been bought by the gold, by the central banks. And so you have to ask, why are the central banks buying it? And it's my belief that they've been buying it as a hedge. They've been buying it because of the uncertainties of the geopolitical world. And that, of course, is what has happened in the last 2 years. The common denominator is Mr. Trump. And the only certainty of Mr. Trump is the uncertainty that he creates. And so that applies to everything from the erosion of the rule of law, as we see, the international rule of law, the domestic rule of law, its institutions in the states, in the quest to trim governments. He's been really abolishing a lot of the big departments, and that creates uncertainty, but it creates a lot of uncertainty. Tariffs, for example, which are now at the highest levels ever since the Great Depression. And why that is bad is that even though he has climbed down on a lot of the tariffs, it's still at 15%, 16% plus. And what that means is that, and the recent study just came out this week, that the American public, the American businesses are the ones that are pay for those tariffs. It's not been the foreigners. So that takes a big bite out of the US economy. And then Mr. Trump, what did he do? He lowered taxes through his big, beautiful bill. He not only lowered taxes, but he also has now he gave big increases in immigration, for example. There's been dramatic increases in spending in areas. Defense spending has gone from it's now $1 trillion defense spending. He wants to boost that to $1.5 trillion. What does this all mean? What it means is that when you add up all the figures, and you don't read about it in the papers or they're talked about, Mr. Trump is the biggest spending president ever in American history. And their deficits are approaching $2 trillion a year. And what does that mean? To give you a perspective, that's something like 8% plus of their GDP. Interest payments alone on $39 trillion of debt is something like $1 trillion a year. That's more than he was spending on defense. So how does he accomplish that? Well, all that money that's he's spending is flowed into, of course, the stock market. This is why we're enjoying the good times. But when you look at the performance of the stock market, it's principally 7, 10 stocks. And lately it's been artificial intelligence. More money has been raised in artificial intelligence than any other sector. And that boom, of course, has created wealth in the stock market. And the American public today, something like 60% of the American public have some exposure to the stock market. That's up from less than 40%. So what that all means is that when the stock market goes up, everybody feels very comfortable and happy with their with their being. But the reality, as we saw during the housing bust and during the in 2008, the financial crisis, when you get a bust and affects a lot of the Americans, the economy goes into a recession. And we have today is that we have a two-tier market. We have those who are invested in the stock market, and then we have the other people who are paying the freight for higher taxes, higher insurance, higher car prices, higher electricity. What does that all mean is that inflation is a big problem in the United States. And that is another reason why you buy gold, because gold is a good inflationary hedge. Historically, it's always been a hedge against inflation. At one time I can recall in the late 60s, 70s, the President Johnson then had his Great Society, plus he wanted to give everybody a tax break. He wanted to boost the economy, but he also was fighting the Vietnam War. And so it was, as they call it then, guns and butter. And history shows you can't have both guns and butter at the same time. That means a big boost in spending. Well, that big boost in spending resulted in the great inflation of the 70s, excuse me, where inflation went into double-digit levels and interest rates had to go to double-digit levels by Paul Volcker in order to depress inflation, because inflation was near hyperinflation. So what I say is that you have to look through history to see what's happening today. And so I look at the 70s and today, I think that Mr. Trump has chosen guns over butter. Defense spending, wars, everything from the outright wars in the Middle East to the currency wars that we have now. We have an economic war with the trade war. And soon we are going to have a currency war because the US dollar has fallen more than 10%. Now, Mr. Trump has said, yes, that's all right. I like a lower dollar because that means I can send much more, help our exports. Well, that also boosts inflation because Americans, guess what? They have to bring in food. They have to pay for higher prices. American manufacturing is only 16% of their economy. Consumer spending, the consumer, is 70% of that economy. So the reality is that when you have inflation, it really hurts. And I look historically, what does that mean? Well, you have rising inflation. Normally, the central bank would increase interest rates. But Mr. Trump has been trying to suppress interest rates. We now have a new Fed chairman coming in, and dollars to donuts, you will see pressure on lowering rates. So when I look at ahead, there's this cocktail of continuing inflation, more government spending, uncertain geopolitical climate. You have tariffs. You add that all up, and it creates a lot of uncertainty if you are an owner of assets. How do you protect yourself? And therein lies one of the appeals of gold.
Hmm. Yeah, very interesting. Well, why don't we even go further back in history, with gold probably being one of the longest standing exchange of values, going back, what, 5,000 years, maybe more, you correct me. Th- how is it there's nothing else that's lasted like that, like in terms of currencies, etc.? Like, maybe just take us back to the beginning of time, well, how humans traded goods, and why did gold really last?
Well, David, we were not around then. But, history shows that when the Egyptians, and even before that, gold was an asset that was a commodity that it wasn't easily available. It was hard to find. The Romans then had gold coins, and what history learns, even going back to the Romans, is that with their gold coins, that because governments, even the Roman governments at the time, they wanted to spend when you had the different Caesars in, and they weren't enough. They were fighting wars at the time. There wasn't enough coinage, so they cheapened the coins themselves. They made it copper based, and then surrounded that with gold. Um, and then some civilizations even silver. They made silver as coins, and as a backing for currency. The point of the exercise, when you go back those that period, and even in the American Civil War, they had silver based as a against their coinage. The Chinese, before Mao Zedong, had a silver coins. Uh, the problem with governments is that because you can't duplicate it, you can't put it in a Xerox machine. You can't do it like Bitcoin today and just create it with a click of a computer. Uh, there is a tendency to say, okay, we'll create a piece of paper that will give it value. And in the 1700s, in fact, that's what they did. It was, and during the French, they said, well, we will abolish coins as gold, silver as a backing. We'll make a value against land. The churches had lots of land at the time, and will issue receipts for the land, and thus the creation of paper as an alternative. And there's a term called fiat. It's not fiat; it's just more than a car. Fiat means a paper currency without a backing, and this is what we've had today. At one time, that the dollar was backed by gold. And then, of course, in the 30s, Roosevelt, after the Depression, they abolished, they went off the gold standard because they needed to create money to get out of the Depression. And then, but they went back to a coinage when they seized all the gold from American citizens and gave them paper instead. That, of course, changed in the 70s when they said they allowed Americans to buy gold. Gold went from $100 to $200 an ounce. But in 71, because of this paper inflation, and inflation went to double digit levels, we had President Nixon abrogated. He went off the gold standard, and since then, gold has gone from $35 to what, 5,400, and now back to 5,000. So there's no question that paper versus hard currency has always had value.
Okay. While you were talking there is making me realize Americans are woefully underinvested in gold. And have you ever heard of the phrase, it's un-American to own gold? And if so, why was that and is that? And how could that ever change?
Well, it's changing. I mean, that un-American was because, again, because Roosevelt, what they did was they seized, confiscated the gold from every house, and it was un-American to own gold. And notwithstanding the fact, in the '60s, I can remember a firm that I was with had an office in Windsor, and we would have a lot of American clients. They would come in to buy gold and gold shares, South African gold shares, because they could not do that in the United States. So it was that's where that came from. Um, but the reality is that on average, I think of gold as a percentage of assets probably about 5%. Um, I advocate 10 to 15% in any portfolio today. And I think that with all the geopolitical uncertainty, there's no question that that is increasing. So my sense is that, and I swing back to the gold mines, that you have to look to know who produces, because who owns the gold today? There's only the world. There's only mine about, I think it's 40,000 tons, something like that. Of gold. There's
Mhm.
not much gold. Central banks are the big holder. The Americans are the largest holder, 8,300 tons. Canada, I might add, has no gold.
Mhm.
The Chinese have come from nothing. Now they are the fifth largest holder in gold. And Poland has been a big buyer of gold in the last 2 years. And my sense is that the central banks will continue to be big buyers of gold. So there is the demand side. I have no problems in looking. It's the supply side.
Mhm. Yeah, the Canadians sold down their gold reserves decades ago. I forget which prime minister, was
Mulrooney,
behind. Yeah, Mulrooney, I guess, was the ultimate culprit. But a while ago, there was all this bluster that Fort Knox, which supposedly hasn't been audited in several decades, may or may not have any gold. And I thought this Trump regime was going to actually show us that whatever happened there. Why that just stopped happening.
like all promises, it's yet another unfulfilled promise. Yeah, he was uh, a good part of the Republicans um, have always advocated gold before Ronald Reagan, et cetera. That, and in fact, there was a gold commission, and the gold commission, there was about this stack. I think there are four big books and blue books on the gold commission, and they advocated bringing back the gold standard. And there are a couple senators, Rand Paul Jr., have been pushing it. And they've been saying we should go back to the gold standard because, after all, it's on the nation's books at $42.22. So you pick up $11 billion plus quite easily by just revalue it. Well, even more so today. Um, that's a possibility. But I think that it's the Americans are spending at such a rate that now, in fact, through the Genius Act that they passed through Congress, that they're looking to see cyber coins as a way to fund the deficit. But as we can see with Bitcoin and with some of these meme coins, that they are very volatile, and what goes up some often comes down. So, and in addition, I can't recall when the last time I've seen Tether release an audit of of their financials. So there's a great uncertainty. So one thing about the gold standard, and no nation is on a gold standard, that politicians like to spend, and it's our money. So sadly, that's why gold is a good protection of assets.
Hmm. Let's go back to inflation. And you commented on the 60s and 70s having not quite hyperinflation, but double digit and peaking out in 1981. And then we all know the story of Paul Volcker coming in and moving rates, short term rates, from 4% up to 12. He bumped them up 8 percentage points, or 800 basis points, as they always talk nowadays. And uh, obviously, the governments of the day nowadays just couldn't do that. It would bankrupt the whole country. So, how will they ever get inflation under wraps, or can they?
Well, the, the problem is that inflation is a dynamic animal, and as the Americans are finding out, it's hard to suppress. It's like a coiled spring, and I believe that while inflation is running, they say 2.7, it's a lot higher when you look at electricity prices going up 38% in the United States. Um, what you look at is and I go back through history. You look at the Great Depression. What caused the Great Depression? Was it inflation? No. What caused inflation at the time was you had the Roaring Twenties, where money was very easy. Money went into everything. You had the creation of radio. You had steel companies being formed, the car, Ford. It was a happy period for the stock market. Um, and then, of course, a slowdown turned into a recession, and the recession turned into the Great Recession and then the Depression. And that came about because money supply shrank. Literally, money supply, just they reduced it by something like 30 odd percent in total. Um, Everybody feels okay. Are we going through a period like today? No, I don't. I think there's some similarities. There's the autocratic regime, there's the robust stock market. But this time, when you look at money supply is the raw money that's produced by the Fed, David. And last year, year to date, the money supply has grown 4.76%. It's growing at a pace that will generate more inflation. It's gone up 160% since 2000. Today it's at the highest level, $22.3 trillion dollars. That's raw money. That's more than and when you create that much money, it's hard to have a depression because so much money. Invariably, and the noted economist, American economist, Friedman said, listen, money grows but doesn't grow on trees. The inflation is a monetary phenomenon. And that's the reality, is that if you have a lot of money, and we created a lot of money, of course, during COVID, we had all the stimulus programs and that, and we're creating more money now because of the defense spending, as I mentioned, and the great beautiful bill. So all this means we have a toxic combination of more inflation, not less inflation.
Okay, let's move into specifics about gold companies, the majors, and the developers and juniors. First of all, like, gold's risen so much, and inflation has affected the gold mining companies as well, of course. But the spread between how much they can actually make after all costs, how has that changed? Where is it at right now on average, approximately? And maybe just fill in the all of our listeners as to what's gone on there and might continue to go on.
That's a great question, David. What's happening is in the mining industry that they are not finding enough gold to replace the gold they're producing. We reached peak gold, and we're not bringing on enough new mines. It takes 10 years plus to build a mine from the first discovery to getting it permitted to raising the money for drilling it off, from getting the equipment to process it. And it can take that long. So when I look on the horizon, the mining industry really starved for exploration. They were just trying to exist. And so I can recall when all in cost, for example, might have been $200 an ounce when gold was under $1,000, and some gold miners had tough making money at that with those margins. Today, on average, the all-in costs are something like $1,500 to $1,600 an ounce. I think after we see the fourth quarter numbers that it will increase beyond that. With a margin of $5,000, that's terrific. If you're in Canada, you're talking about a $7,000 gold price, which you're getting for your ounce that you produce.
In Canadian
So
dollars.
in
Yeah.
Canadian dollars, so it's a terrific. And so, what have the gold miners been doing? Well, they have paid down debt, so the balance sheets are excellent. They probably have the better balance sheets than our banking system today. They have been giving out through buybacks, returning, buying back their shares, and that's increases the value of the companies. And for most of them, they've been paying big dividends. So a great fundamental companies. But only this year last year and this year are they spending money on exploration. So that's the key, because exploration is the lifeblood of discoveries. If you don't put a fishing line in the water, you're not going to catch a fish. If you're not going to explore, it's going to be difficult to find a gold mine. So last year there was a lot of M&A transactions. It was cheaper to buy companies on Bay Street than it was to go out and go fund a gold mine and find it and then build it.
Mm-hmm.
The problem is that it's sort of like musical chairs. There are so few chairs available now today. So my expectation is there'll be an increase in exploration. So the producers such as Barrick, which I continue to recommend, MacNicol's done well. The second tier group of stocks, Eldorado, BT Gold, all look very attractive. But my sense is that developers are where the money is going to go. And the developers mean is those companies that have already discovered the gold mines, drilled it off, have created what they call PEAs, preliminary economic assessments. In a lot of cases, even feasibility studies, bankable feasibility studies. In other words, they can go to a bank and say, okay, here's our numbers, give us the money. But nowadays, gold mines cost billions of dollars to produce to get that ounce of gold. So you can't no longer go to a bank because banks are not putting up that type of money. So sometimes you have to finance it through the markets. Sometimes they're financing themselves, a combination. But it's the developers where I think is a sweet spot that's still upside for the gold miners.
Okay, and just step back a bit. You recently got us into a company that specializes in I won't be able to pronounce it and say it properly, but photovoltaic assay reporting. And just explain to people what the company does and how they tried to assess gold mines before that, and how this newer technology is making things easier. And maybe give a little plug for the company.
That's a good question. I mean, I own it myself. It's called Paragon Technologies. PALS, I think, is the stock symbol. They recently became public. What they are is an assay lab, in essence. Assays is that when you drill for gold, when you find gold, I mean, gold could be on the ground or most times underground. and you have to go 1,000 kilometers or 500 meters deep. All along is that you get drill core, and you slice that drill core, you break it up, and you send it to the assay lab. And as you travel down through the earth, what you want to know is that whether you're found the gold zone, and if you did, whether in fact, what do the rocks look like, how the grade of that. So assay labs are very lately, because of the booming in gold mining, are very busy, and sometimes it can take a month, 2 months just to get the return. Paragon, that technology is by using, part of it is artificial intelligence, part of it is technology, is they can turn around in a day those assays. So they have sold three of their assay labs. The equipment comes from a US based company that they have an exclusive with. And Barrick uses it, for example, like MacNicol uses it. In Canada, McEwen Gold. In fact, McEwen Mining has uses it. They liked it so much that they bought a third of the company, which is brought to my attention. And I think that this company will become, it's sort of like the picks and shovel. Not only could you buy the gold miners, but you should buy the picks and shovels, because in the gold dust days, it was the equipment people who made the most money rather than the gold miners. So why take that risk? So it's the picks and shovels of the gold mining business. I was down in Guyana looking at a company that we helped, Oh My Gold, for example, and they are a developer, and it takes a month or so to get assays and back, and I'm trying to persuade them to go down to Suriname, Guyana, to because there are only the archaic assay labs down there, and there's a shortage of them.
Well, then, yeah, you hit on an important subject in Oh My Gold Holdings, and one of the best stock tickers that I've come across, OMG, which every person probably uses the term OMG too much through their course of conversation. But OMG dot or dash V, maybe tell us about the CEO and how she's different and maybe more unique than many other CEOs that you've seen in the industry. And then let's talk more about the company and some of the, what might happen in the future.
Sure, I also own that. We have been to back up a bit in the being in the gold mining business. As I mentioned, you see all different characters. I go back when there was the Murray Pesum of the world, when in the '60s and '70s there was a stock promoter, and Murray had more ideas and more. But one distinction, other than his notoriety, was the fact is he found gold mines. And I, in fact, helped Murray one time. We created a company. I said, Murray, you see about every gold mine or every prospector in the world comes across your desk in Vancouver and shows you what he has and looking for financial backing. And he said, yeah, yeah. And I said, I know. So I created a company called Prime Resources to help him with the help of Ned Goodman and Norm Keevil Jr. and a whole bunch of mining people, Noranda. And we raised about $100 million. And we said to Murray, you see every deal, find a good one and we will back it. Well, he found Eskay Creek, and it was 100. Well, Murray found Hemlo also before that, but that's why I met Murray. But anyways, what I discovered was that mining is just, it's a game. It's sort of like trains. You have trains every day go by your door, and over the decades, every mining prospector, a lot of them come across our desk and come into our boardroom and they pitch ideas and that. And I believe that you have to listen to a lot of the stories, because somewhere there are the needles in the haystack. There is the odd gem in that. And Elaine Ellingham was a person who I knew from her background was she was with a lengthy period with the stock exchange. When I was chair of the stock listing committee at the time, and Elaine was in charge of mining. And when I traveled around the world, I would see Elaine. She would be plugging the Toronto Stock Exchange, come and list with us and that. And she knew pretty well every miner as well as I did. And when Elaine left, I said, what are you going to do? She says, she had a good Rolodex. She said, no mining. And she joined a company called Richmond. And Richmond was a company that was down they had a discovery in Quebec, but they mismanaged it. They raised money, they mismanaged it. And she came aboard because she had a good mining background. She knew the principles, and she had a geological background. She's a geo. And she set aside rearranging the company to the point of even drilling program, and they found reserves, but she decided to drill a deep hole. And that deep hole was the big gold discovery, so to speak, that enabled that Richmond was eventually bought over by Alamos, and Alamos is one of the main mines is now Richmond. So Elaine went away, made a lot of money, and she came to me a couple of years ago, I guess, and she said, "I have this deal in Guyana," and I said, "Oh, I remember it," but I said had a lot of shares outstanding, and they had, again, I thought they were mismanaged. And so I watched Elaine, and she came to me and she said, "This is what I want to do." And it made a lot of sense to me. And so we raised some money. I went down to Guyana to have a look see, to meet her team. It was a very small team at the time. It was second time I was in Guyana. I've been in Suriname of joining it, and Guyana is it's in Latin America, but it's a country, a very small population, British background, and but Exxon had discovered something like 900, almost 900,000 barrels, a billion barrels of oil offshore. And you can see and now they are producing 900,000 barrels a day. So Guyana went from a very poor country, is now they've refused to join OPEC, but is now an up and coming country, very safe country. I met government officials, met Elaine's mining team, some Guyanese, and I said, and there were very few countries there at the time. There was a lot of Chinese. Zijin was down there, and they had all the ingredients. And so when I went out to it, Omai was a former gold mine that was produced gold 3.5 million ounces, but left by the Canadians when they had something that they thought was better, and the gold price was around $300 and at the time. So I thought there could be a lot of potential underneath that they missed. And sure enough, Elaine drilled it off, and we continued to raise money. Others continued to raise money. And now she's got 6.5 million ounces, and she's going to have an updated PEA. And my expectation is that she's got money in the till, 50 million plus in the till. She's going to drill that off, and it will be one of, I think, is a potential tier one asset. So the stock has performed well, and my expectations it will perform even better because the update of the PEA, the drilling program that she's currently conducting, and that will lift the stock. So, as I mentioned, the developers, I very much think is the sweet spot of the market.
The other day we were talking, and you did just off the top of your head a valuation based on a recent transaction, and sorry to put you on the spot again, but maybe just remind people of a recent transaction and how that might look if OMI was to be taken out.
No, Zijin just took over something called Allied Gold, which is principal assets are in West Africa, and they had about 5 million odd ounces. No, I forget how many ounces they have in the ground. Very short life. It's principally the Sadiola mine. It's something that I did not like because it had a short life. But Zijin is the largest Chinese, not state-owned gold company, paid $570 an ounce in the ground for reserves. So in the older days, or you would pay maybe $200 an ounce for reserves in the ground. And that $570 is a pretty attractive number for West Africans. So to translate it to, and it's really early days on something like Oh My, David, you're looking at there's 670 odd million, probably $4 plus. But again, she's got to prove it off, those reserves, et cetera. That. But my point is that increasingly there's a lot of million ounce in the ground wannabes, but there are very few with 5 million plus, and that's one of the attractions.
Yeah, yeah. Okay. Anything else you want to cover on OMI before I go to some just general questions that my colleagues have put together?
No, I think that's enough on them.
Okay. Here we go. Some of these you've probably already. Here's going back to the beginning. What are your thoughts on gold pushing from 2,000 to 5,000 so quickly? You maybe just go back a bit on what you're talking about earlier.
Well, just to go back, I can recall from gold getting up from 1900. Well, gold. Let me give you some background. From gold was, I said, was $35 in 1971, and it went up to $850. You were around in 1980, and that was the great inflation that we talked about. That's something like 2,300% move. Now gold corrected. It corrected down to $250 odd in 1999. I mean, gold is very volatile. But I can recall in 1999 saying, listen, $250, maybe $500 would be a target. Well, gold went up to $1,900 in 2011 to complete that move. That's something like 653%. What happened, of course, in 2011, that was after the financial crisis of 2008, 2009, and the recovery, and of course all the inflation that came afterwards. So then gold corrected to $1,900 to, as I said, in 2011. And so when you look at 1900 to today, it's only like 180 odd percent, 175% move. So historically, this were the third leg, sort of. We haven't seen anything yet from a historic standpoint. So my point is that yes, there's upside. Gold doesn't go straight up. I mean, we've had a move, the move from 2,000 to 5,400, and in a few days we added $300-400. So in a day it was down to $5,000, or my sense is that yeah, you'll probably find support around here. How high? I have a near term target of 6,000, but honestly, I don't know how high gold can go. A point I make to tell everybody, David, is that it's not that gold is doing so well. It's that the US dollar, other currencies, inflation, purchasing power is doing so poorly. That is why gold is moving up.
Yeah, yeah, yeah. No, you just made me reminded me. I started my business, or our business, I should say, in 2001, September of 2001. My previous partnership, who will remain unnamed, wouldn't buy gold, and that was back then. The Americans had a relatively high debt level. Now it's not even comparable. But I remember my entry price in 2001 was $284. I don't that number is always stuck in my head, and now to 5,000 plus. It's just been a tremendous run. But oh, and I know what I was going to say, and I bought the physical gold through Nick Barishev,
Oh,
who had written
yes.
in around then. He's no longer with us. $10,000 gold. I'm sure you got a copy of that book. Do you see 10,000 in the horizon?
I don't know how high it will go. I mean, it's possible. It just pick a number. People often, for a long time, I can recall in the '90s or yeah '90s saying $2,000 in year 2000, and everybody laughed and thought it was I was shirtless and it took a while in the year 2000 for it to hit $2,000, but um, you just don't know. I mean, I remember giving a speech just a year ago, a year of $5,000. I thought when I was asked, and I said, yeah, it's a possibility because of a measured move in that. And I was reminded of three people who were at the emailed me, and I forgot about that forecast. And I just don't. You pick a number,
Yeah, I hear
but
you.
I think the best lies ahead. That's my point.
Here's a good question. Do the majors hedge their production at these levels?
The answer is no. I think Barrick showed when they lost billions in hedging, and it cost them a fortune. What they have done, however, such as I Am Gold when they funded Centerra, is they had they sold forward and calls, and that it is like a hedge, and they did it for about 150,000 ounces, and they were handed, it cost them money. um, that's one of the problems I think in with some of these royalties, not to beat them up on the royalty side, but royalties are an expensive form of financing for a lot of the gold miners because you're giving up a good percentage of that upside too.
Yeah.
And they do well. Royalty companies do well in the bad times or in the flat times. But on times like today, when gold is rising, the royalty numbers, while they've done well, they're not going to do as well as when you get the leverage from a gold producer.
Okay. Um, do you see more upside from here forward in the juniors or the majors?
Oh, definitely the juniors. Um, I think the juniors have gone up, but nowhere near what you've seen if you compare the performance of the GDXs to the juniors to MacNicol Eagle, for example. I think that the juniors will do much better.
Here's something back on politics. This morning, Trump nominated Kevin Warsh as the new Fed chair. Given his relatively hawkish stance and likely unwillingness to just do Trump's bidding blindly, how will investors factor this in their calculus of potential inflationary monetary policy error risk and the role gold plays in relation to it?
Well, I'm afraid with American politics, we must remember that what happened one day can change the next day. You must remember that Jerome Powell, was a Trump pick.
Yes.
And what they were talking about, Mr. Walsh, is the same what they're talking about, what they talked about Powell. When you get into that office, it's yes, they change a bit, but central bankers, while yes, they are independent, they also read the tea leaves, political tea leaves. The point I make is that what Mr. Trump has done is he's created a fiscal policy that's the largest spender on earth, president, not the largest spender. Also, now monetary policy. He wants control of the piggy bank, not only control of the Fed chair, but he stacked now the Fed governors. And there's a question mark that people should ask you, will Powell stay as a governor? Because if he doesn't stay as a governor, then there's another open spot for Trump to pick. Point two I'd make also is that the Federal Reserve is also in charge of the banking system. So another responsibility, not only just the monetary financing the administration's monetary stance, is that a fiscal problem, is that he'll be in charge of the piggy bank if he gets control. And what I mean, the banking system, it's everything. It's how Wall Street runs. It's the swaps, everything, and that's what Mr. Trump wants control of. And if that happens, that is why the independence of the so-called Fed is important.
Okay, some things, a couple of questions here, because otherwise we could go on forever, because we both enjoy this subject so much and it's so relevant. What about shifting gears here to rare earth metals, this whole Greenland notion? And just give us your thoughts on that, and maybe any areas that we should be looking at.
That's a good question. I spent last 5 years researching rare earths. I financed some rare earths. Um, I visited China, looked at rare earths processing. Must make 2 points I would make. One is rare earths are not rare. It's everywhere. It's in water. What's the difficulty? It's processing. Yeah, you can get rare earths from water, but it would cost you a fortune. The problem with the West is that processing, that technology, we shipped it out. We let it to the Chinese because we cared so much about the environment that we did not want the pollution, the toxic waste. We still don't want it in mining. So processing is the key, and that technology, it's not something that you can buy. It's very, very difficult and expensive. So yes, indeed, rare earths are valuable because of the processing, and because now of tariffs, we now have dueling tariffs and all that, and embargoes and export restrictions and that. So I've looked at magnets, I've looked at rees and that. That's an area where the governments are throwing so much money at. And I looked at one in Texas and Colorado, one where, yes, the reserves are there, but to get it out, the community will not allow it, and it will once you release it, it will affect the water system. So there's more money than brains that's going into that, and so I'm very cautious when it comes to financing it.
And I mentioned Greenland. That would be a natural
Rob
place to
McEwen.
mine. Yeah.
I'll give you a good example. Rob McEwen was 15 years ago. McEwen Gold is a company that is way ahead of a lot of players, and it's something that I recommend as developers in that. But Rob McEwen was there 15 years ago and looking at that, and he's not there. That tells you something. There's no shortage of rare earths, but you got to find it, then you got to process it, and that's the difficulty.
But then, as you mentioned a moment ago, and the communities won't allow it in civilization.
Well,
So in
mining
China,
is
they
a
can get away with it because they really don't care about the environment, in my opinion. And maybe that's a thought for Greenland because of its small population. And who knows? It's more than just a.
Well, Greenland is infrastructure, David. I mean, it's just to get around. Look at Nunavut. I mean, there's MacNicol Eagle spent billions in Nunavut. I mean, they were one of the few northern mines in the world. With that, you had to bring technology. You had to. It is not easy mining. You have something. Nova Gold, Donlin Creek, where a power line alone will cost you $1 billion.
Yeah,
Infrastructure is very difficult.
yeah, yeah. Okay, final question. We've talked an awful lot about gold and silver. There's other precious metals like platinum, the hardest one in the world to get from the Earth's core. Maybe just give us your thoughts on that, and then maybe any other industrial metals that people should be looking for.
That's a good question. I finance a platinum producer,
Mhm.
South Africa. The difficulty, A, is South Africa itself still with mining. They were once the largest producer in the world, and now they're not even, they're in the top 10, but they're number 6 or 7. Platinum, as we know, it enjoyed a big rise because of catalytic converters, car industry. But when you had the EVs, then you didn't need the converters. So
Yeah.
that affected a big part of it. Yes, in fact, there is a market for it, and yes, it's done well. But you can't dance with all the girls at all at the same time.
Yes.
So precious metals, yes, as I mentioned, gold is a critical metal, and that's why I focus on that.
Okay. And no comments on industrial metals like copper or anything like that?
Copper is I mean, copper is it's skookum. I mean, it's the electrification of the world, data centers, and that. There's no question, copper. There is no shortage of metals in the world. What the shortage of it is the cost of extraction. That's why we go to Latin America for copper. It is, yes, you can mine copper in the Rockies, but try and get a mine, even gold mining, through BC. Yes, they shortened it from maybe 10 to permitting to 2 years, but just try and go through that process. Um, Copper definitely looks interesting,
Yeah.
but there's no shortage of copper.
Hmm. Hmm. Okay, well, this has been wonderful, John. I really appreciate your time and your insight and foresight. And once again, thank you for everything that you've brought to us. And I think you're batting well over 500, so you would be the top of the majors, and that's great for us. Final personal question: are you going to hit the indoor track for a run at lunch, or are you going to go outside?
Unfortunately, I have another lunch right after this booked. Otherwise, but it is minus 20 here.
Yeah.
So yesterday I just hit the treadmill. I did 5K on the treadmill.
Good for you. Well, keep it up. It keeps you young, and do appreciate the time here.
Thanks for listening to Lighthouse Outlook. If this conversation sparked a new perspective, share it with someone who thinks differently. Subscribe for fresh episodes every 2 weeks and visit MacNicolasset.com to learn more.